Welcome, everyone, and thank you for joining today's BMO digital event on the global trade outlook around tariff risk and the incredible movement of energy prices all around the world. I'm Brian Tobin. I'm the Vice Chair of BMO Financial Group, and I'm Chair of BMO Nesbitt Burns. Before we dive in, I think we should reflect that two developments are reshaping the global trade and market backdrop. The first of those is the decision on February 20th of the U.S. Supreme Court to invalidate key emergency tariffs. And the second is to put it mildly, renewed volatility in global energy markets tied to the conflict in the Middle East, specifically the war between the United States, Israel, and Iran. These two together have increased uncertainty around trade policy, energy supply, and near-term market conditions. Today, I'm very fortunate to be joined by a panel of experts to discuss how global trade could evolve this year, the potential impact of higher oil prices on trade, or oil prices generally that are being whiplashed, how U.S. tariffs will be used to support President Trump's economic agenda, and of course, the risk to the U.S. Canada trade agenda. Joining me, we have Steve Verheul, the former chief negotiator for Canada. Steve, perhaps we can get you to raise your hand. Thank you very much. Sal Gutteri, the director and senior economist for BMO. Sal, welcome. And Francis Trahan, the chief investment strategist for BMO Capital Markets. Steve, Sal, Francois, thank you for being here. And Steve, let's start with you. With the Supreme Court ruling removing what is really the key pillar of the U.S. tariff framework, how has the Trump administration pivoted its trade strategy this year? And what does that mean for the scope and timing of new tariffs?
Well, thank you, Brian. And first of all, it's a pleasure to be here and join you today. The Supreme Court ruling against the International Emergency Economic Powers Act is clearly a serious blow to the Trump administration's tariff policy. No other option that they have in front of them is as flexible and easy as that mechanism. So what they're doing is for the short term, they're going to use Section 122 of the Trade Act of 1974, and that allows them to impose tariffs of 10%. They could go up to 15%. To impose those tariffs against countries. But there are a number of flaws with this particular approach. First of all, that approach does not allow for different tariffs to be applied to different countries. So that undermines many of the deals they've done with other countries based on preferential treatment. Secondly, you can only maintain those tariffs for 150 days, and then the U.S. administration would have to seek approval from Congress, which I think it would be unlikely that they would be able to get at this point. And secondly, this Section 122 tariffs, these are also being challenged before the courts. If they get to the court, they will almost certainly lose that effort as well. So that's the short-term measure, and they will be able to use that for a while. But what they're planning in the longer term is two separate mechanisms. One is Section 301, also of the Trade Act of 1974, and that allows them to pursue unfair trade barriers or practices of other countries. And they have already announced two investigations that they're pursuing. One is an investigation on countries that have structural excess capacity in production and manufacturing sectors. They've targeted that to 16 countries. That does not include Canada, but it does include Mexico, the EU, Japan, Korea, and others. And the second investigation they've launched includes the notion of the failure to impose and effectively enforce prohibitions on imports of products produced with forced labor. That will apply to 60 countries. It does include Canada, Mexico, and others. But that will take a while to unfold. These investigations typically take, well, they have up to 12 months to complete. So there's a timing issue that's going to creep into all of this. But Section 301 is their main avenue to try to reimpose some of the tariffs they lost with the Supreme Court ruling. The other element is that they will continue with further investigations under Section 232, so-called national security investigations. That's where we're facing tariffs on steel, aluminum, autos, and other products. We could see further investigations on that front coming forward. But I think that overall, the approaches they have in front of them now are nowhere near as flexible as what they had under the former regime. And we're going to see a lot of uncertainty going forward. There's no escaping that.
So Steve, you've been at the table. You've been the chief negotiator. You brought Canada to an agreement that served us very well for a long period of time prior to this this administration's attack on trade initiative. You put it that way.
Yeah.
Let me ask you today, when you look at the Canadian opportunity and/or challenges in terms of a trade agreement with the United States, vis-a-vis, for example, Mexico, who would you want to be advising? What table would you want to be sitting at today in terms of the challenge to get a deal done?
Well, I think Canada is in a good position. I think that the U.S. has been already conducting a lot of these discussions. They're fairly well advanced with Mexico, not so advanced with Canada. But I think in many ways time is on our side because I think the pressures on the U.S. are only going to increase over time. I think that their whole approach on tariffs is not providing the kinds of benefits they thought it would provide. They were looking at reshoring production to the U.S., but manufacturing starts were down every month in the U.S. last year. Manufacturing jobs were down. The trade deficit actually increased, not decreased. So I think that it's really a question of Canada being prepared to wait this out a bit because the pressures on the U.S. are going to increase, not decrease.
How do the pressures we've seen in the energy markets through the course of this conflict in the Middle East, the rapid increases, and now we saw last night, prices coming down at West Texas and Brent dramatically overnight. How do these impact the environment for a trade agreement between Canada and the United States? Bearing in mind, of course, that Canada is the fourth largest energy producer in the world or oil and gas producer in the world. We are still a significant supplier to the United States, yes. And there's more to come.
Yeah, there's a lot more to come. And it's not just oil and gas, it's all kinds of other products where Canada plays a pretty central role. It's aluminum, it's potash, it's propane, helium. All of these commodities are seeing rapidly increased prices because of the conflict, and we'll see what kind of disruption that has going forward, depending on how it sorts out. But I think all of the volatility that we're seeing in all of these areas really leads investors to kind of sit on their hands because they're not sure what the world looks like in the coming months. And they're not sure what kind of trade policy the U.S. will ultimately pursue. So there's a lot of caution being built into all of this. And I think that we're going to see increasingly that there will be further pressure to try to get to places where we have more stability, more predictability. And that's positive for Canada because that's what we're looking for. And that's where we want to be positioned with respect to the review of the existing agreement between Canada, the U.S., and Mexico. So I don't think it's not necessarily a bad issue from the Canadian perspective. We just have to be patient and let some of this roll out.
Let me take this, Sal, to this discussion over to you. We've heard about the trade uncertainties in our discussion with Steve, the tariff risk, the geopolitical tension, oil prices fluctuating up, down. How are all of these feeding into BMO's outlook for inflation and economic growth in both the United States and Canada?
Brian, not in a good way. I mean, all three uncertainties, especially higher oil prices, have led to adverse revisions to our growth and inflation outlooks recently. Um, Based on previous oil price responses estimated by the Dallas Fed, we did lift our inflation forecast for both the U.S. and Canada this year by more than half a percentage point to over 3%. We also cut our growth estimates by 3/10 of a percentage point for both countries. Now, still to a decent 2% for the US, which is being powered by the AI investment boom, but to a more modest 1% for Canada, where business investment is being held back by tariff uncertainty. Now, our forecast still assumes the Iran conflict permanently ends this month, that is beyond the current 2 week ceasefire, and the Strait of Hormuz fully reopens for shipping, and there's no severe damage to the energy infrastructure in the Persian Gulf. In that case, U.S. oil prices could average around $100 a barrel this month before retreating below $80 by next year. Now, that's still above pre war levels of $67 due to a higher risk premium, simply to reflect possible renewed conflict in the Middle East. Where we really start to worry, though, about recession risks, especially for Canada, is if oil prices are sustained above $150 a barrel. In that case, the loss of spending power and weakness in global demand for Canadian exports would likely override the income windfall for Alberta to tip the national economy downward. Thankfully, that risk has diminished in the past 18 hours.
Well, I'm looking at as you speak, I'm looking at oil prices, and they're down in the case of West Texas, 16%, in the case of Brent, 13.5%. So a nice move downward as the world responds to the 10-point plan, which is widely interpreted rather differently depending whether you're talking to Iran or talking to the United States. But nevertheless, good news is there is a plan, and the conflict has thus far paused. What are the implications, Sal, on the shifting trade policies and energy shocks for central bank decision making, particularly monetary policy expectations, both for the Federal Reserve and for the Bank of Canada? How do you read that one?
Yeah, Brian, it's probably apt to think of tariff and energy price increases as shocks to both demand and supply, as they work like a tax to erode spending power and like sand to gum up supply chains. That's a pretty tricky mix for central banks to handle because the shocks have adverse effects on both growth and inflation. While the central bank's one policy lever, interest rates, can be adjusted to address just one effect at a time. So, on top of that is the extreme uncertainty about where tariffs and energy prices are going. So basically, the central bank is driving handcuffed in the fog, which case the best approach is simply to pull over to the side, remain patient, assess the data to see whether the shocks are hitting growth or inflation harder before responding. Now, the problem there is due to the lag policy effects, you run the risk of being too late to offset
Yeah.
the effects, and you still end up with a period of weak growth and high inflation. Now, prior to the Iran war, we thought the Fed would cut rates at least a couple times this year, starting this summer. Now we're unsure whether it will cut even once, but we still believe some further easing is likely if the war ends and oil prices retreat. As for the Bank of Canada, we see no moves for the foreseeable future, as the bank seems pretty comfortable with the current 2.25% policy rate, providing much needed support to Canada's economy without pressuring inflation higher. We strongly disagree with the market's expectation of one rate hike this year, as we suspect the tightening bar is pretty high, given low core inflation, modest, fragile economic growth, weak labor and housing markets, and just the uncertainty still about the USMCA review.
So I don't want to put words in your mouth, but I'm wondering if you've just told us that a change of leadership at the Fed doesn't necessarily mean, in the context of current economic environment and challenges, a change of Fed policy. notwithstanding the many, many comments of President Trump in the past about Mr. Powell.
Well, we know that Kevin Warsh, who is the nominee for chair to replace Powell, assuming he is approved by the Senate Banking Committee, does favor lower interest rates simply on the basis that the U.S. now is going through a technology transformational change driven by AI, which in theory at least should increase productivity, support economic growth while driving down inflation. So you kind of get the best of both worlds. And that could open the door to cut interest rates, at least reduce interest rates to more neutral levels from perhaps modestly restrictive levels now. So that kind of underlines our view that the Fed probably is still leaning towards cutting rates. In fact, the median FOMC member is still penciling in one rate cut this year and another next year. So we're still of that view. But again, a lot will come down to the direction of the Iran war and where oil prices ultimately land.
Francois, from a market perspective, how are investors responding to the combination of credible trade uncertainty and geopolitical risk? What are you seeing, Francois, as the biggest sources of volatility across, say, a variety of asset classes?
Yeah, I think investors are confused, and which is not surprising. Every time you face something you haven't experienced before, it's kind of a scary time that you have to acknowledge that there's a lot of unknown unknowns, as Dick Cheney used to say. And we all have to accept that things can change with a simple tweet. So I think going into this, there was definitely a big negative bias, and so I think a lot of people are confused by how resilient the market has been. I think if I'd polled my clients, mid-February and asked them, "What do you think is going to happen to the S&P if oil prices go up $50?" I don't think anybody would have thought that at the very worst, the S&P would be down 7% and change. So we have a lot of special circumstances, if you will, that have made the market resilient. We have stimulus in the pipeline, both monetary and fiscal, so that insulates us a little bit. And we're also an oil producing country. And it's clear that those that are oil producing are seeing their stock markets perform better than their equivalent, that import a lot of their energy needs. And so to answer your question on volatility, it's been in those countries that are dependent on energy imports that we've seen the biggest drawdowns. So the Kospi in South Korea, the Nikkei in Japan, those are countries that are very more vulnerable, certainly, than the U.S. or Canada are, if you will. And so that's been initially, at least, the biggest source of volatility.
Well, I think you're absolutely correct when you say that many people, and I count myself as one of those, are quite surprised at the strength of the market, notwithstanding all of the complexities implicit in what's gone on over the last period of time. You talk about the power of a tweet to move the market. It does seem that tweets move the market on a regular basis, presidential tweets in particular. So given this backdrop, what portfolio strategies or risk mitigation approaches do you advise for investors to consider to navigate potential trade surprises in equities and fixed income and currencies?
Well, that's a really interesting question, because you have to put things in context. It's not your traditional sectors that are leading the market. I would say for the first 3 weeks of the conflict, growth stocks were kind of the main theme, if you will, holding up the market. I think the NASDAQ was actually flat for those first 3 weeks. Week 4, something changed. Well, interest rates started moving higher, but I think the market began to acknowledge that there would be a lingering effect on inflation from these events, even if they ended now. And so, if you're looking at the entire conflict, the 3 sectors that stand out are energy, which has been the best performer, utilities, REITs, and their commonality is that they all represent hard assets, if you will. And that's kind of your go-to inflation play. So I think for the first 3 weeks, the market was more concerned about what this might mean for the economic outlook, and that's your reflex to turn toward the growth stocks. Beyond that, I think it's really become worries about inflation. And so the more exposure you've had to those three sectors, the better you have done. The compromise that we really liked, the reflex in a situation like this is to put blinders on and to only think about the crisis, but you don't want to ignore the underlying backdrop, which is one where, if you think about where we were in February, we had all this stimulus in the pipeline. Leading indicators in the U.S. were starting to look better. It looked like we were going into a recovery. And so I do like these late stage cyclical sectors. Energy would be part of that. Industrials, materials, they are a hedge for higher inflation, and they also work, when economic prospects are improving. And it looks like, assuming that this detente does last, that, we will have a combination of those two stories between now and the end of the year.
How about the NASDAQ? When there was a ceasefire announced, the biggest pop this morning, markets opened up, was there in the NASDAQ amongst that whole sector. How should we be thinking of NASDAQ companies?
Yeah, so in the last 2 weeks, you've had a growing correlation between the price of oil and interest rates. And so in my mind, it's a little bit of a derivative effect, if you will, for the NASDAQ and, the growth stocks. Because oil came down abruptly, as you know, overnight, so did interest rates. And growth stocks tend to carry higher multiple. They tend to be very sensitive to changes in inflation. So they're getting, quite the pop today. I don't know if that lasts throughout the year because it's, as Sal points out, it's becoming more difficult to see a Fed that is able to ease policy later this year. It's certainly a murky outlook for now. And so I don't think that that growth is necessarily your best segment between now and the end of the year. So I would prefer to, I look at an index like the Russell 2000 has a lot more cyclicality to it. It's actually higher than where it was when this crisis started, up about 5% on the year. And so to me, that's a sign that the market still cares about the underlying story, if you will.
So what are you saying then specifically to those who've put some cash aside, set on the cash, said this is all very volatile. I'm standing on the sidelines, at least with a chunk of cash. Is this the time to get off the sidelines, or is it the time to sit pat for a little bit and see what more develops?
Well, we have to acknowledge that there's a lot we don't know. Everybody's hopeful, I think, particularly today, but time will tell. The theme I like is quality cyclicals. And by design, that's going to push you into the energy sector, the industrial sector, the material sector. Those are segments that are holding up well during the crisis, and they were in leadership mode before the crisis. So, where the underlying backdrop is basically supportive of cyclicality broadly defined, if you will. And they're a hedge for inflation, which is why I think they've performed so well, relatively speaking.
So let me come to all three of you with a question that's broad, but gives each of you, given your area of expertise, of course, all of your expertise intersects at a certain point, a chance to weigh back in by asking you this: as business and investors look ahead to continued trade uncertainty, as Steve has told us, we're at the table right now, but not formally there, but the process has already begun. What's the single most important signal or development that we should all be watching to assess how global trade and markets may evolve over the rest of this year? Steve, do you want to jump in as chief trade negotiator, perhaps give some texture to the question, and perhaps we'll have our two colleagues jump in and add to your comments.
All right, sure. Well, I think from my perspective, the single most important element is whether or not the U.S. maintains the exemption we have under the USMCA going forward, because that does cover 90% of our exports to the U.S. And I think the U.S. has maintained that exemption throughout the last year, originally put in place in March 2025. As long as that exemption remains in place, we're not in a bad position, and we have the prospect of negotiating something better. If we were to reach a point where the U.S. removes that exemption, then we're in a whole different world. So I would see that as probably the most important indicator going forward.
Sal, you want to jump back in?
Yes, I would agree entirely with Steve's assessment. The compliance exemption for Canada is everything. It really could determine whether our economy continues to grow, even modestly, or possibly slip into a modest downturn if we lose that exemption. So that's really important. But I also think the White House, at some point, will have to clarify whether it merely aims to replace these lost IEPA duties or plans to go further than that, which would greatly escalate the trade war. Going from an average effective tariff rate of around 11% on U.S. imported goods back to the pre-SCOTUS ruling level of 16% wouldn't be a big problem for markets, as we already know the U.S. economy can handle it, and other economies will gradually adjust to it. But going well beyond that rate, say closer to the post-Liberation Day average of over 25%, would mark pretty serious escalation that could materially slow the U.S. economy and global economies. Our main forecast assumption, of course, is the former. We really don't, we won't rest easy, though, until the White House has ruled out that latter risk.
And Francois, your comments?
Yeah, I would say with regards to the U.S., Brian, this is going to sound a little lame, but the price of oil, where oil is able to stabilize, the level at which it stabilizes will tell us a lot about the outlook. Sal talked about hopefully getting back to, sub $80 oil by the end of the year. That's an improvement on where we are today. It's obviously not where we were in February before these events. We were closer to the mid 60s. And thinking about the Canadian side of this story, the US dollar, I think, is really important because it's a little bit of a real-time proxy for the state of the global economy. And so a weaker dollar is usually associated with a world economy that is gaining momentum. And so I would like to see this decline in the US dollar continue. Hopefully today is the beginning of something.
I've got time for one more snapshot that I wanted to get in if we could, and maybe we'll start with you, Steve. Mark Carney is out working hard to diversify Canada's economy. He's been to China. He's been to many other jurisdictions. He's trying to make deals everywhere he goes. We know President Trump will be with President Xi soon. Is Carney on the right path? Does it have impact? Is it making a difference at this stage?
Well, I think overall it is making an impact, and I think it's the right direction that we should be following. But there are a couple of points of tension. One is that most of what we're doing with respect to diversification is in natural resources and commodities, and not so much on manufacturing. And I think manufacturing is the weak spot for us with diversification. And then secondly, where there's going to be an increasing tension between our efforts on diversification and the U.S. efforts in the USMCA review to try to forge tighter alliances within the North American market. They want to have common tariffs on strategic products. They want to have common approaches to investment screening. They want to have common approaches to export controls. So we're going to face that increasing tension between how do we preserve our access to the U.S. market and improve it, and how do we move forward on diversification efforts.
Thank you. Can I have quick comments from you both? And Francois, perhaps start with you on Carney.
I think Prime Minister Carney is got the message from the U.S. that this is a structural change. The issue with trade agreements is that they take a long time to put in place, and so I think it's the right reflex, but I think it's going to take time before we see the fruits of this effort.
Fair comment indeed. Sal, last word to you on this.
Yeah, well, like most economists, I'm a fan of free trade, and I think the more deals we can sign with as many countries as possible, the better for Canada.
Steve, Sal, Francois, this has been a great discussion with three obviously super talented and super experienced commentators on and practitioners of making this economy work well. We thank you all. And on behalf of the rest of the team at BMO, thank you for joining us.
Thank you.
Thank you.